Guys, these are 33 stocks that I want to own forever. What does forever mean? As long as the fundamentals stay the same and they're good allocators of capital. Stock number one, Microsoft. Guys, we like to discuss Microsoft. It is the best software business out there. They've converted to subscription-based model. They have Office 365. For those of you who aren't old enough to remember, you used to have to go to the store and buy what's called a CD. And it looked like this, and you put it in your computer, and you download, and you installed the app, and then you had Microsoft. But guess what? You might have the same version for 3 to 5 years. That was awful. Office 365 is way better. It's like $5 a month. It gives you the entire suite of Microsoft products, and there's so much great stuff. It is the number one market cap business in the world at $3.2 trillion. That's what's incredible about Microsoft. Now, guys, for this stock and the rest of this video, I need you guys to do me a favor. Write in the comments below which stock specifically you want me to do a deeper number dive into and use our stock analyzer tool to figure out what the right price is. Stock number two. I don't know if you guys have heard of this company. It's a very small company called Google, or as I like to refer to it as the Googly Moogly. For those of you who don't know what Google means, it is a 1 with 100 zeros behind it, and this is actually spelled incorrectly. It is not spelled this way, I believe, and please verify, it's G-O-O-G-O-L. That's how you actually spell Google, but they did a great job. Top 2 search engines in the world are Google and YouTube.com, the very platform you on right now watching our video. These guys own search. What I also love about them is they're increasing the percentage of their revenue that comes from cloud computing, right? Microsoft's got cloud computing, Google has it, Oracle has it, IBM has it, Amazon has it, but this revenue keeps increasing as a percentage of their overall revenue. They've got a low amount of debt, so this company can last the test of time. Guys, yes, technology is fickle, but imagine having to replace these top 2 search engines. And I love YouTube because as we've learned more and more about YouTube, we realize YouTube's goal is to make sure you spend as much time on a video as possible. So they're going to reward creators like me the longer you stay on. That's what I love about them. With Google.com, I explained this in a recent video about Google. They don't necessarily charge the number 1 spot the most money. If you have a great experience and you're going to Google.com and you're sticking to that number 1 link, it could actually be cheaper than the number 3 link. That's what I love about Google. Stock number 3 that I want to own. It's a doozy. It's an airline. Love Southwest Airlines. Southwest. Guys, this, I believe, is the best run airline in the world. Until COVID, they had 48 or 50 years straight of profitability. 48 to 50 years for an airline, guys. Most airlines have gone bankrupt twice in that kind of time. These guys have been profitable. They hedge their gas costs extremely well, and they stick to one plane. Now, that one plane is a Boeing 737. That's been an issue as of late. That's what I think is driving down this cost. And their historical margins before COVID were bottom line of 10 to 15%, and they're currently at 3 to 4%. My entire thesis is that it'll eventually go back up to this, and once it does, this is a very valuable company that I'd like to own forever. Now, in full disclosure, Southwest is probably the one I'd watch the most because it's already in a tough industry. And unfortunately, tough industries can sometimes make great companies not so great. So I'm going to watch this one the most. Stock number 4, Meta. One of my biggest mistakes. Guys, one of my purchases of Meta was on November 4th, 2022. I bought it at the low of $88 a share. I was dollar cost averaging. It went all the way to $195 within a few months. And I said, too fast, I'm going to exit now and wait for it to fall. This thing has gone up to 540, 550. Guys, I hate myself for this. I literally hate myself for this because I knew this was not the move that I should make. So I'm waiting to be patient before it makes sense for me to buy this company again. I think it's a little overpriced at 540, but I think that when everybody was criticizing me as I was buying it close to 88, saying I was wrong on it, guess what? It started to skyrocket right back up again. I think this company, if I can get it with a 2 in front of it, I would be extremely happy. Meta owns WhatsApp, which I think is the number 1 messaging app. They own Facebook, and they own Instagram. These 3 things get 3.5 billion of the 8 billion people in the world on their services. Guys, if you're not in the US, You know what WhatsApp is. In fact, when you're in a foreign country, you don't sit there and say, what's your phone number? Say, what's your WhatsApp? Give it to me. Let's talk. I love WhatsApp. I wish it would be adopted here in the US because it is a far superior messaging service to iMessage or whatever poor ass service that Android uses. Guys, stock number 5, Home Depot. High return on invested capital. This is where doers get more done, right? Isn't that their slogan? That is their slogan. Great company, growing internationally, provides a great service. I will get into Lowe's later, but Home Depot, I do love it. I want to wait for the right price. They have great hair. They're going to grow internationally. It's just a company that I believe in, that I want to own, but I got to wait because it is retail, so I got to be a little bit more cautious about it. But if you want to go learn how to get things done, you go to Home Depot as well. So Home Depot, number 5. Number 6, American Express. Guys, if I asked anybody right now, what's the number 1 luxury card? People would say American Express. Nobody's saying Visa. Nobody's saying MasterCard. Doesn't mean these aren't great companies. They're on my list as well. I'll explain to you later. But American Express is the elite service for people who want, every single person I know who's ultra successful has an American Express card. They use it. They love it. They use it for the perks, everything like that. Now, the only issue with American Express, you're going to think this is funny, free cash flow is far greater than net income. You might sit there and say, but Paul, you love it when free cash flow is greater than net income. I do. But it's so different that it makes me wonder, do I not understand something about the business of American Express? I own American Express currently. I'm waiting for it to be a little bit better price because it's skyrocketed from here. Number 7, Berkshire Hathaway. Our good friend Warren Buffett. And back when I did this video originally, Charlie Munger was still alive. But obviously, Charlie Munger has since passed a few weeks before his 100th birthday. Great company. Now, I will say this, though. I feel that people just love it because it's Warren Buffett. You got to remember, as they get more and more capital, it's going to be harder for them to beat the market. So what I'm waiting for is very, very, very low times in the Berkshire Hathaway valuation. What's that mean? Well, Warren Buffett always said we would buy back our shares all day long at 1.2 times book value. What's book value? Assets minus liabilities. So you take the assets minus the liabilities, multiply by 1.2. If the market cap is below that number, I'm probably going to buy it. I'm not going to buy Berkshire unless it's an obvious purchase. And I think that's an obvious purchase. There could be great times to own it, but it's so large. I'd rather just own the S&P 500 at that point, unless it comes to the point where it's so cheap, I've got to buy it. Stock number 8, Apple. Guys, do we have to talk about Apple? Apple's so big. They generated $107 billion in free cash flow last year. This company, at one point was the largest company in the world with over $3 trillion in value, has since been passed by Microsoft. But this company owns people's experience with electronics, and I love that. I'm just glad that Tim Cook, or as Mo likes to call him, Tim Apple, is learning a lot about capital allocation from Warren Buffett, and I hope they do a lot of great, in the future, buyback of stock at the right time, because this is the kind of company that even with 3 to 4% revenue growth, which is what's expected for this company, they can buy back shares and really drive up EPS to levels that would really increase the value of the stock. And that's what's really important here. I believe Warren Buffett buys Apple for under 140, but I think his number is a lot higher than most because he just has so much capital to allocate. He'd be fine getting normal market returns for Apple. Now, back to the credit card business. Stock number 9, good old Visa. Guys, Visa is the credit card company. What percentage of people have a Visa in their pocket? I mean, it's got to be some absurd number of people who have a credit card have a Visa in their pocket. It's incredible. They're all over the world. As the world GDP grows, what's going to happen to Visa? Visa is going to grow along with it. So I'm a big believer in Visa, high gross margin. That means every dollar they bring in, a big percentage of that goes to the bottom line before overhead and taxes, and their bottom line margins like 50% plus. Bottom line, after taxes, after overhead, after interest, after everything, over 50%. High margin business can really, really drive up their earnings per share. And stock number 10, their competitor, MasterCard. Now, MasterCard, another great company out there, but not like Visa, but I like it sitting there saying, hey, this is one that Guy Spier likes a lot. Now, you might be wondering, well, Paul, if you're going to own all the companies, why even have that? Well, because at different times, different companies are going to be valued differently. So it allows me exposure with American Express, with Visa and MasterCard, I can pick the exposure I get along the way based on their valuation. So if this one's valued better than this one, much better, I might go buy this one. If this one's valued better than this one, etc. I can keep doing that to get my exposure to the entire world of credit card at a good valuation. That's what's most important for me. Now, guys, 11th company, Alibaba. China. Scary. Not necessarily for me. My thesis on Alibaba is I understand that China has some geopolitical risks right now. I do not deny that. However, I think about 10 or 20 years from now, do I think China will be around and a bigger economy than it is today? I absolutely do. Even with a declining population, they have a fast-growing middle class, a lot of potential here. Baba, I believe, is selling at a price that makes it absurd relative to the situation at hand. Am I right? I don't know, but it'll play out over the next 5, 10, 20 years. The point is, I'm willing to bet on Baba going forward based on its current multiple. I own Baba shares. And again, don't buy it just because I do. You have to be comfortable with the experience. Because guys, I want to show you Alibaba specifically here to show you guys the chart on what I mean about how scary it can be. This is Alibaba's chart over the last 5 years. All-time high, 319 on October 27th, 2020, and it has just gone down from there. Guys, I'm not going to lie to you. I believed it was worth 200 plus. The lucky thing I had was I wasn't willing to pull the trigger on China quite yet. And then when it got stupid low, I was like, okay, let's start buying this thing. Now, I have bought all the way along the way where my basis has gotten good. I'm still in the loss on it. Doesn't bother me one bit. Doesn't bother me one bit. That's what's most important. Guys, you have to be okay with this. Remember, you're going to buy companies based on fundamentals, but you're going to hold them and you're going to make money on them by understanding the fundamentals continually, but also having the emotion to withstand this. Even if you're okay, even if you're looking at this going, this has been flat for a long time. Am I okay with that? That's what I'm trying to teach on this channel. You've got to understand the fundamentals, but when the stock price isn't reflecting the fundamentals, are you okay with that? Investing is so difficult emotionally. Every great investor would tell you that they made their money by just sitting, and sitting is difficult. Just sitting and doing nothing is so hard, especially when you're alone at home. We've all made terrible investing decisions because of emotions. Nobody's immune to that. Munger's done it. Buffett's done it. I've done it. Guy Spira's done it. Mohnish Pabrai's done it. Every single person in the world, you're not alone in that. And that's exactly why I created the community. I didn't want you sitting home alone, worrying about your investments, watching it go sideways or watch it go down, to sit there and say, did I make the right decision? Am I wrong? You will make the wrong decision as you lament on those things. But with the community of thousands of like-minded investors, it allows you to go in there, talk about the fundamentals, and when you're worried, talk about the emotion of it. We all feel better as we talk through our emotions. Now, I'm not telling you that you might sit there and you might sell the stock realizing, you know what, this was a bad buy. I made the wrong decision here. That's great. Getting out of a bad purchase is just as smart as staying into the right purchase and letting it run. But letting it run is how you're going to make a lot of money and pay less in taxes. It can help you compound. So when it comes to this community, I created the software for the fundamentals. I created the community to handle the most important part, which is the emotions. So guys, click the link below if you're interested in joining the community. We're starting something new very, very soon. We're going to limit the number of users allowed in per day. And the reason we're doing that is because of the demand, we want to be able to make sure we gave people the right experience going in. So there'll be a limited number of spots every day. Click the link below, $7 for 7 days to sign up and try it out. Stock number 12, guys, Lowe's. Now, I will say this about Lowe's versus Home Depot. Customer service at Lowe's is much better. When I go to Lowe's, people ask me, do you need anything? And I love that. But again, just like the credit card companies, I've got Lowe's versus Home Depot, and I can pick and choose based on valuation. I think Home Depot is the bigger brand, but I think Lowe's has a better customer service, better selection process. So you might sit there and say, well, Paul, why even have Home Depot? Because I think they're both great companies. And I just want to pick and choose based on valuation. That's something that I enjoy doing. That's what works for me. Stock number 13, guys. McDonald's. Now, I'm going to tell you guys something here. I'm going to pull up my McDonald's app because I want to show you how many reward points I have at McDonald's. And you might be like, oh my God, Paul, you sociopath. I only downloaded the McDonald's app probably 6 months ago. And I already have 106,000. 617 points. That's what happens when you go to McDonald's 6 out of 7 days a week. Every morning, I get a sausage burrito, no sauce, and a large Diet Coke light ice. That's what I do every single day. 6 out of 7 days a week. Now you might sit there and say, that's disgusting. I'm disgusting then. I love that sausage burrito. It's a tortilla, it's eggs. Guys, McDonald's is awesome. They do a great job. They're growing their franchise. They're changing their menu. They're changing their stores. I love McDonald's. I just got to wait for the right price for McDonald's. I don't own any shares quite yet. Okay, now, stock number 14, Disney. Similar to Southwest. Margins are low. Revenue is at all-time highs. Margin is around, what is margin? About 3 to 4%. When historical, again, is just like 15% or so. So I'm banking on this. I'm banking on 3 to 4% becoming 15%, or even if it's 10%, it's worth a lot more money. Yes, have they had a lot of issues lately with the Bob Iger and the Peltz guy trying to get a board seat with the woke movement, blah, 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 blah? Yeah, but I think those are temporary. I think Disney's got an incredible library of content that they will have for a very long time. Disney Plus is doing well. So many subscribers. Could they lose some? Sure. They also own Hulu. Guys, big fan of Disney from the standpoint of valuation. I own shares. I would like to buy more shares. It has skyrocketed on me since I bought it. That's okay. Guys, the number 2 software business I consider is Adobe. Guys, this company has incredible software for video, imaging, all that stuff, and subscription business now. That's what I love. Again, back in the day, you had to spend $500 buying Adobe software. You had it for several years before you upgraded. Now it's a subscription software business with really high margins. These guys are incredible. I've never been able to buy it based on valuation. Could be because I'm not understanding valuation. That's the art of investing. It's so difficult to find these things. Guys, Nike, I want you guys to know something about Nike. We made the 30 stocks video about 3 months ago. Since then, Nike is down 15%. Full disclosure, I just sold puts on Nike. What does that mean? I sold somebody the right to force me to buy Nike at a lower price. It's currently at $90 today. I love it. Now, you can sit there and argue why Nike is good or bad, etc. But I look at it and I said to you, if I said to 100 people right now, number 1, apparel, sports business out there, what would they say? I think a large majority are going to say Nike. That's the brand I love. High margin. They're getting into more direct sales, which are higher margin sales. These shoes are freaking hundreds of dollars each. People buy them. I love Nike. And I really hope I get these shares at the price I want. I hope the stock goes lower. That's the big key here, guys. You've got to remember, when you buy a great company, you want it to go lower. That's part of the emotion and the mindset I want to teach you. You got to sit there and say, I hope the stock goes lower and I can buy more of it at a cheaper price. A stock with good fundamentals, the value will go up like this, but the market will go like this. Your goal is to sit there and buy it at the right times. This is for just individual stocks. Hold a piece of your money together for stocks if you want to pick individual ones. Still put the majority of your money, in my opinion, into long-term ETFs because you don't want to miss out on those opportunities. But when it comes to individual stocks, you sit there and go, if you're able to find Nike at this point, why would you not? Even if you bought it all along the way here, you're still going to average this price. You're going to do quite well when it's all the way up here. You're going to do quite well. That's the point. Buying great companies and I consider it to be great prices. If you can do that, you will do well picking stocks. But again, it goes back to the emotion of it. You've got to be able to say, shoot, Nike was at $180 a share at one point. It's now at $90 a share, a 50% drop. So if you bought Nike at 180, you're wondering, what the heck? That's in the past. You got to look at where is Nike today relative to the future. That's what's so great about the community and the software. Guys, my next stock, Ferrari. I've discussed this all the time. Ferrari is the ultimate moat. Why do I think that? Gross margin of 50%. Don't confuse GM for General Motors. Gross margin of 50%. In the car business, it's hard to find anything above 20%. They're 50% gross margin. Every car they sell, 50% of that is profit for them. That is incredible. Net margin, around 20%. Guys, their net margin is higher than most car companies' gross margin. Ferrari is a luxury brand. They only sell 13,500 cars a year. they could double that tomorrow and probably still sell out. Ferrari's awesome. It's wonderful. If you want to buy a new one, go buy a used one, then go to a Ferrari dealership, register as an owner, put your order in. That's the way to get a new Ferrari. And I love that. Next stock, something very similar to Ferrari about luxury brands, Louis Vuitton. Now, Louis Vuitton's got a lot of different companies within it. I love watches. They own Hublot and Zenith. This is not Zenith, the TV company. This is a very nice brand for watches. Hublot, another wonderful brand. Love Louis Vuitton. They don't give discounts on their stuff, on Louis purses, things like that. That's what I love about that company. Bernard Arnault is one of the richest in the world. He goes back and forth with Elon on being the richest. But that's a company that I love because they really are all about protecting their brand. Next stock, T. Rowe Price. This is a company I own, want to buy more of. Big asset manager. Now, if stocks do what I think they're going to do over the next 10 years, this company will probably struggle, and I'm okay with that. It pays a high dividend for those of you who love dividends. I'm okay with it because I don't know what else they can do with their money, but the second the stock falls, I want them buying back shares. But this is an interesting company to me. I think they're a great asset manager for people, for a lot of widespread people, and as the markets go up over time, this stock should do well with it. Next stock, one of Cleveland's own, Sherwin-Williams. Sherwin-Williams is building a beautiful new skyscraper in Cleveland for their corporate offices. When everybody else is losing their properties to foreclosure, Sherwin's building that office building. They cover the world in paint. This is the company for paint. If I ask 100 people, name me a paint company, I think a lot of them are going to say Sherwin-Williams. We also buy a lot of flooring from them, a lot of carpet from them. They do more than just paint. This is another company that I like a lot, that I think to myself will be around for a very, very long time. And that's what I'm looking for. I just need to be patient for the right price. Another company involving homes, Generac. What does Generac do? They make generators, and their generators are good. Now, this is a company I own. I bought it cheap, around $83, $84 a share. It skyrocketed. Everybody's like, wow, nice job. Poop. I want it to go down further. I think these are the go-to guy for generators. I like this company a lot. I think they're right under the radar and not many people know about them. They're not like a name brand that you sit there and say, hey, who's your favorite generator company? That's not going to happen out there. But once you want a generator, these guys pop up in there and they're under the radar. So people aren't going to pay much attention to them to drive up that stock price. Another company, also one that's a little bit under the radar, Starbucks. Just kidding. I just bought Starbucks recently because the stock has fallen a lot. I like their worldwide growth. I like their same-store sales growth. I like a lot about them. And I love the fact that people are willing to pay $10,000 for a cup of coffee. Talk about legalized drug facilitation here. They're literally the legal drug dealers. And I love this about Starbucks. People are addicted. Literally in New York City, you'll have two corners right there, Starbucks, sometimes another Starbucks right here. It's incredible. I love their peppermint hot chocolate. That's what I drink. And I also drink actually a low-calorie, like double chocolatey Frappuccino thing that my wife showed me one day. I'm like, yes, I'd love to have this. So another great company that I can't wait to own more of. Go, guys. Next company, Otis, elevator company. 15, 20 years ago, I owned buildings with elevators. And back then, the hourly rate for an elevator repairman was $225 an hour. And I thought to myself, what a racket. But then I realized how much effort goes into those elevators. And with limited space, people have to go up. I'm not saying there's limited space in the country, but in certain cities, it is cheaper to go up. These guys, and the elevator union is a very strong union. This is what I'm looking at for Otis. Just got to buy at the right price. They are the elevator people, in my opinion. So I'm sitting here saying, okay, I'd like Otis. Next one, new one added to the list, Intuit, QuickBooks. Guys, I use QuickBooks even for my personal spending. I don't just use it for my business. I actually treat my personal spending, that revenue in as income, my expenses, my budget, everything. I don't use, like money, Microsoft Money. I don't think that even exists anymore. But the point is, I love QuickBooks. I think they're a great resource for small business. And it's another company where you used to buy the software for $100, $200. Now you have a subscription. Great business model. I love it. They're making it better. And how do you compete with QuickBooks right now? How? If I told you right now, go out there, there is competition, don't get me wrong, but QuickBooks is the gold standard for small business bookkeeping. And that's what I love about them. Okay, next one, Costco. Now, guys, I'm not going to lie. Costco drives me nuts because Charlie Munger loves it. Everybody on Twitter loves it. They sit there and talk about what a great business it is, have to own it forever. Logged in, it said, sorry, we're sold out, sucker. So I was like, whatever. But Costco, keeping their warehouse is very simple and awesome. They're all about the customer. That $1.50 hot dog, please, guys, what you think of it, because I think it's an incredible business, but too expensive for me. And even though Charlie Munger loved it, RIP, the point is I just can't justify that right now. Next stock. Target. Guys, I bought Target from 135 all the way down to 105 or so. If and I go in, we get our stuff, and we move on very quickly. Self-checkout, it's great. But I think Target's doing a great job for figuring out how to do online orders. People get things very quickly. That's what it's going to take to really stand the test of time in retail. Speaking of retail, TJX is TJ Maxx. Guys, the reason I love this one is when it comes to retail, Conan watched her put the thing up in the bathroom. Please don't ridicule me. So I don't do it, but I highly encourage her to do it. I eat my ice cream as she does with a great fixed set of income coming in term. Sprouts Farmers Market. Guys, 4% profit margin now, and I haven't bought shares in a while, but I do own this company there and apply it to your own companies. CTAS, Cintas, the uniform people, based out of Cincinnati, Ohio, started by Richard T. Farmer. Dick Farmer, let's call him Dick Farmer. Cintas, they do a lot of things, fire extinguishers, uniforms, rugs for office buildings, quiet, under the radar, non-sexy business. That's what I love about it. That's why I'm excited about it, because it's cheap and a dollar generated from Cintas is still the same dollar it's generated from somebody else. ANJ, Johnson & Johnson. Guys, I need to say anything. They just dominate the market of everyday home supplies, medicines, things like that. This is a company that's going to be around for owning it at the right price and watch them slowly and steady grow their revenue and profit all along the way, and then left to go be like employee number 20 at Microsoft. But either way, Procter & Gamble, very similar to Johnson & Johnson, home products. The last company on my list, HSY. I don't care about this whole Ozempic thing. People are going to still love chocolate, cheap, and paying out their dividend. That's what's going to happen, because I imagine it's not very easy to sit there and find brand. If we have Hershey Kiss, we have all these Hershey things. It's hard to go with